Good afternoon. Welcome to our FBF online seminar. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance. And it's a real pleasure for me to welcome you all to today's online seminar on the low interest rates environment for this first online seminar of the year. I'm very glad to welcome our lead speaker of today, Daniel Gros, who is the director of CEPS. CEPS is one of the leading European think tanks, if you don't know CEPS already. I will not present Daniel, neither CEPS, to you today. His biography is available on our website, so have a look if you're interested. I think that today's discussion on low interest rates and public debt is particularly timely, and you will probably agree. There have been numerous calls by leading economists and central bankers over the past months for a rebalancing in the policy mix from monetary policy towards fiscal policy. We haven't observed much action on the ground, I would argue. And one might think that the low interest rates environment should be conducing to a more expansive fiscal policy. Well, maybe not. And we'll hear more on this today with Daniel, whom I'd like to thank for his availability. Many thanks also to my colleague Jan, who has supported the preparation of the seminar and is managing our platform as we speak. Before entering the fascinating discussion of today, what I'd like to do is to inform you about our school's upcoming activities in really just a few minutes. Some of you already know a key line of activity of our school are residential training courses, and you will see on the slide who typically attends them. You will notice that since the school's creation in January 2016, we have trained more than 2,500 participants coming from more than 70 countries. Let me seize the occasion to inform you, indeed, that some scholarships are also available for our courses next year. You can find more details on our activities on our website, but let me just flag four courses, which could be of interest to you. In early February, we'll have a course on financial stability and prudential policy with Professor Rocher from Geneva and Professor Parigi. Still in February, we'll hold a course on bank recovery and resolution, and this course will include several practitioners and academics, including practitioners then from the European Central Bank, from BaFin, and from the Single Resolution Board. It would be great to have you on board there. In April, we'll host the third edition of a course led by Mito Gulati from Duke University on managing and understanding sovereign risks, and which will be co-taught by Lee Buchheit and Ugo Panizza. So that's going to be really a law and economics course, highly appreciated in past editions. Lastly, in June and early July, we'll have a course on safe assets and RTC, so the regulatory treatment on sovereign exposure, which will be led by Sam Langfield from the MIT and by Per Callesen, the governor of the Central Bank of Denmark. As mentioned, we have plenty of other courses in the pipeline over the next month, so just have a look at our website or on our LinkedIn page, where you will have a regular feed of activities. As regards our online seminars, our next event will be next week. That's on the 14th of January, and we'll have a seminar on anti-money laundering with Professor Peter Aldrich from Queen Mary London and with Nikita Divisenko from the UI. Right. So I'll stop here on the information provision. I'll just provide you with a last round on the participants, who is in the room. So where do you come from? You see that on the slide from Europe everywhere, virtually, except Ireland this time, and then from a lot of other countries in other continents. 44 nationalities are represented. We're very glad to count on several participants from both the public and the private sector. There are a variety of backgrounds, like always, but this time the majority of you comes from the public sector. We have 40% of women participants and 60% of male participants. You have almost 10 years of professional experience on average. And this time, 70% of you are trained economists, not a big surprise, the remaining share being made up of lawyers, business backgrounds, and other profiles. Lastly, 71% of you have a master's degree, and 34%, which is quite a high figure by comparison, have a PhD, 5% have a bachelor degree. So, time to start. How will our seminar be structured? Daniel will speak for about 25 to 30 minutes. I know that Daniel, you have slides for much more though, and that you were suggesting to skip some slides on the way. Sorry. Following your presentation, then Daniel will open up the Q&A session where you participants will have a chance to provide your questions or comments simply in the chat box that is actually appearing, that would be appearing in the flow of the presentation. So I'll stop here. Leave the floor to Brussels. I just invite Daniel, if you hear me, to connect your mic and your camera and share them with the platform. It's two separate operations. It's nice to see Place du Congrès again in Brussels. So Daniel, the floor is yours.
Thank you, Pierre, for this very nice introduction. It's a pleasure to do again this seminar with you. I must say the audience is a little bit intimidating with all these very experienced people in this virtual room at least. And I hope they will bear with me for some, how to say, unorthodox considerations on the topic which you already introduced. And let me just start immediately, if you allow me, with basically the motivation and the context. You already mentioned that. And as I say on this slide, for me the question is it so certain that low rates really favor higher deficits? And I wanted to put some question marks behind that. Let me add immediately that those of you who have followed the literature know that actually we know that at present both real and nominal rates are low, but low real rates are not really that new. We have had them in the past. What is really unprecedented is the low level of nominal rates. Moreover, if one looks at very long rates, one sees that the low rates are supposed to remain, are expected to remain for long, and the option prices imply actually very little uncertainty about that. So that is the environment in which we are today. Now, perhaps as a way of introducing also my considerations, I would say that I have two broad sets of issues which I will consider. And the first one concerns basically the cost and the risk involved in public debt. And the question is whether low rates should entice one to increase public debt substantially. Let me make that clear immediately. I'm not talking about the idea, for example, that you might increase public infrastructure spending, which is between 2.5 and 3% of GDP. And even if you increase that a lot and have it for 10 years, and if you were to debt finance that, you get into increases of public debt of a couple of percentage points of GDP. That's not my concern. My concern is much more something which Larry Summers, I think, put in a very stark way at the AEA meetings in San Diego, when he said, the US political system is such that 3 percentage points of GDP you'll find if needed. Therefore, if the US is willing to defend its record of always repaying its debt or servicing its debt, and 3% is what it needs to be, then his calculation was that then the US could actually go up to a 300% of GDP debt to GDP ratio. At 1% more, that is a risk worth taking. So I'm talking about this order of magnitude, not, as I said earlier, a couple of percentage points here and there. So that is the first set of issues, which is more the cost of public debt, but broadly speaking. And the second point is where monetary and fiscal policy meet. and I will come back to that in a second. So for low rates, I have actually two considerations which I would like to make. The first one is more about data. It seems that the effective cost of public debt is actually higher than interest rates we see in the market. And the second point is more important for me, which is that if you think it through, the marginal cost of additional debt is actually larger than the interest rate. And that's separate from the data point above. And that's, I think, a very important one. Again, not for perhaps countries with very low debt, but after a certain threshold, it will come into play. I will not deal here with something which somebody sent to me, which is a very nice paper by Mauro and Zhu, who actually document that even in an environment of low rates, you can have defaults, and actually a low R minus G negative does not actually indicate that defaults will become less frequent. That is something else, which is, but I think it's a very important empirical consideration. On the more short-term considerations, where monetary and fiscal policy meet, I would actually make 2 points. One is about the PSPP, which, in my view, should not be construed as being a good or potent way to reduce the risk premium in the periphery. And then the second point is that it's very unlikely that you could actually use fiscal policy in a certain sense to save the ECB from its low inflation conundrum. Some of you might have seen a recent Vox piece on this topic. And actually, these two considerations lead me to something else, which is very tentative at the very end, which is that if the aim of the central bank bond buying is to reduce the supply of bonds to the public, because that then in this kind of liquidity world would lead to lower interest rates, that maybe an alternative way to reduce the supply of bonds to the market is by running fiscal surpluses. Right? So in a sense, there's a certain equivalence between the PSP and actually running surpluses. Okay, so that's the overview. And now let me go into the first point, which I said is a data point, which I do not want to belabor a lot. I just wanted to point out that if one looks at what governments say, this is our interest payments for public debt, and you divide that number by the amount of public debt, you get what is called the implicit interest rate on public debt. And you find actually statistics on Amico on that. And they usually show you that you have a higher cost of implicit cost than you have than the interest rate, even if you take the average of long-term and short-term interest rates. Here I've given you the Finland. Why? Because it's the one country for which I have the longest data series for both short-term and long-term interest rates, which are then averaged, that's the blue line, and the implicit interest rate, which is almost always somewhat higher. Of course, one reason why this could be the case is that we are coming back from 30 years, everybody knows that, of falling rates. So the stock of existing debt usually has a higher proportion of, some proportion of debt issued some years ago, long-term debt, and therefore, of course, the cost of debt could be higher than the interest rate if you are in a movement of long rates, long and short terms coming down. But let me here give you the case for the United States, where you see that. So you see, if you want, the horizontal difference between the red line and the blue line should give you of the duration of public debt. And therefore, that could explain why the red line, which is implicit cost, comes down later. But you see, over the last year, something strange has happened. The blue line, the average interest rate, has stabilized over the last 5 to 6 years, and the red line is not coming down much. And that implies that if you then ask what is R minus G, which is the decisive variable in the debt accumulation, then for the US you find something different when you take just an interest rate minus G, or if you take the implicit interest cost of relative to GDP. And that you see here on the next slide, where you see that this is, I think, data for the US. The implicit interest rate is higher than the average interest rate. Right? So whether R minus G is positive or negative depends a lot on what interest rate you take, of course, short term versus long term, but also here I would argue whether you look at the implicit cost as you find in statistics, and that for this case here has been higher than the rate of nominal GDP growth. So, as I said, this is a data point, but perhaps it's worth looking a bit more carefully at this, whether actual interest rates one see represent really the interest rate cost for governments. There could be other costs associated with debt issuance, with perhaps some other financial operations which we don't see in the interest rate. Data point. Okay, now the second point I wanted to make is, and that is more conceptual, is that actually if you think it through, the marginal cost of additional debt is higher than the interest rate, and here I say for highly indebted countries, and you will see in a second why I say that qualification. And that is because we have now many estimates which show that the interest rate on government debt is an increasing function of the debt to GDP ratio, at least above a certain threshold. This certain threshold actually, by the way, is usually taken to be the Maastricht threshold of 60% of GDP. But the point is not so important. The key point is that the Laubach estimates and many others imply that we have a function which is more or less the one that you see here, that the actual interest rate on government debt, usually the long-term rate on the left-hand side, is equal to the riskless rate plus some risk premium, which is a function of the debt to GDP ratio, BT, above the threshold, let's say 60% of GDP. Right? And that is an equation which is used also in many debt sustainability analysis. And as I said, it corresponds to estimates which have been run by many people over many times. And I give you an example here for a country with a debt to GDP ratio of 130%, for example, Italy, right? That would suggest that and an alpha of 0.03, that would suggest that the risk premium should be 210 basis points, and that the interest rate should be then 180 basis points. For Italy, right now, it is actually lower, but this is a ballpark estimate, which is not very far from what we see actually today. Now, a first implication of this simple determination of the interest rate as being a riskless rate plus a risk premium as a function of the debt to GDP ratio is you have a feedback loop. And this is something which I presented already last time when I had some work with Cinzia, where we calculated how would the debt to GDP ratio evolve under the assumptions you see in small print under the graph. So basically you have a constant primary surplus, and you start off with an interest rate, let's say you see at different lines. The top line is one where you have an interest rate, a debt to GDP ratio at the beginning 150%. And the simple point then is, if the debt to GDP ratio is that high, the risk premium will be so high that the country will run a deficit. Therefore, the next period, the debt ratio will be a little bit higher, and the risk premium will also increase a little bit. And you see how this then leads to an explosive divergence or upwards path for the debt to GDP ratio. And here in this case, you just find that if you start with 130%, actually you are almost constant. And if you start actually below a certain threshold, then you will get into a virtuous cycle each year. There will be a slight surplus, debt ratio goes down, premium goes down, and you get into, and that is, I think, very important feedback mechanism which you see in many DSAs. Okay, that is, if you want, mechanical, because you just in this mechanical exercise just keep the primary surplus constant and growth rates and everything else. The more conceptual point is that, and that's for me the key, is that if you look at the interest rate expense, which is basically the debt ratio times the interest rate, and that becomes basically, in this linear example, a quadratic function of the debt to GDP ratio. Because you have this feedback, right? A higher debt ratio means also a higher risk premium. So your interest rate expense goes up on two accounts. And that's what the simple equation you see there, where just multiply the interest rate with the risk premium times the debt to GDP ratio. And then if you just take a simple derivative of this equation, then you find what you see here in red, namely that the marginal cost of debt is much, much higher. The marginal cost of debt is then the riskless rate RT plus alpha times, in this case because it's linear and quadratic, 2 times the debt to GDP ratio above 60%. And then if you do the calculation again for alpha 0.03, and let's take Italy, right? A debt to GDP ratio of 130%, then the simple calculation shows, then you have in the parentheses there 260 minus 60, which happens to make 200, right? And 200 times 0.03 makes then 600 basis points, right? So this is my key point here, that if you look at a country like Italy, you might say, today, okay, they pay 150 basis points. What's so bad about it? Maybe that is more or less in line with nominal GDP growth. But my point would be that if Italy were to go down in the debt to GDP ratio, the interest rate expense would go down on two accounts, not only lower debt, but also lower interest rate. And that is not factored in by many people when they look at the cost of debt. And that also comes, I think, is extremely important, because then if you look at people saying, look, the interest rate is below the growth rate, yes, the interest rate might be below the growth rate, but the marginal cost of public debt is not below the growth rate, most likely, for high indebted countries, meaning countries above this threshold here. And therefore, one should be extremely careful in saying, okay, if the interest rate is below public debt, then one should spend more because the cost of debt appears to be so low. I have put here on this next graph basically this equation in a very rudimental form, where you see the interest rate as the blue line above 60%. You see the interest rate goes up a little bit. It goes up to about 2%. And since here I have put the riskless rate at 0, the interest rate in this case would actually be equal to the risk premium. But the marginal cost of debt increases much, much more, and is much, much higher. And that is, I think, one key point to keep in mind when you say go out and get into more debt, because the cost is so low. It's not the blue line you should look at the red line. There's a kink there, of course, which is due to the threshold effect of 60%, right? But I think the key point is, as I said, the difference, vertical difference between the two and the red line, blue and the red line. So there are, of course, real world application difficulties, which I don't want to get into, long-term versus short-term to what extent the risk premium is actually a function also of maturity and so on. And then, of course, there's finally also the fact that financial markets will anticipate future debt levels. Right? So, for example, in the case of Portugal, once it became clear that Portugal in future is going towards a lower debt level, then already interest rates started to fall immediately. Right? But I think that doesn't really take away the general point that the marginal cost of debt is much higher than the interest rate. So, and this is my conclusion, which I already mentioned. First of all, the DSA based on a comparison SR minus G is misleading, even apart from any uncertainty about future rates. And secondly, as I have belabored several times, look at the marginal cost of debt, not at just the interest rate when you think about whether you should incur additional public debt for infrastructure or some other social expenditure. Okay, now we come to my second point, which is much more, if you want, an issue of short-term issues. And here is a point which would take me some time, which I don't know whether I will actually have it, which is that the sovereign bond purchase program of the ECB actually might have increased the interest rate for the remaining private sector holders. The general point is that in the euro area, actually, if you think about central banks buying debt, and central banks most likely not willing to accept a haircut, then it should be clear that in case a default happens, the loss given default for the private sector participants, for the remaining private sector participants, should increase. Especially also, this is a related point which I don't want to belabor today, if a lot of the debt is held by commercial banks, which also cannot be haircut because otherwise the banking system goes down, and therefore you have a double problem if a lot of the debt is held by central banks and commercial banks. Let me, however, put all that aside and now look only at the PSPP. So the program of the ECB to buy government bonds. And as you all know, this is not about the ECB buying government bonds, but national central banks on their own account buying government bonds. I take that as known by everybody. Therefore, the point I wanted to make, the general point, is that if you look at the risk premium for a private sector investor, you have loss given default which increases if national central banks hold a lot of debt, and a probability of default which might or might not decrease because the central banks are in the market. So therefore, the impact of the PSPP on risk premia should be a priori uncertain. Now, I could provide you with a simple framework which actually shows that it is likely that the PSPP purchases have actually increased the risk premium, and that is happens if you have two elements which determine the likelihood of a default, namely one factor which I would call the liquidity risk, which is something which de Gros emphasized a lot. It's the variable factor, which then depends on the amount of bonds in circulation. Basically, the more bonds you have to refinance at any point in time, the more likely it is, or the higher the danger that you have a liquidity problem. But of course, it might also be just another factor which is independent of liquidity, which is just the debt gets too high and the government is just not willing, or you cannot find the majorities to finance the interest rate expense, and that leads to a fundamental factor which is independent of any liquidity. And in a paper which you might have seen, I have formalized that where the probability of default is a function of a fixed factor alpha here. Sorry, same letter, but totally different meaning, right? Which is a fixed factor, and then you would have a variable factor which depends on this S, and S is the share of the bonds which is held or has been bought by the national central banks. Since I don't want to go too much overtime on this one, let me just leave the model there. I can come back later to that. But basically, if you take this probability of default and then add to that the fact that the loss given default will be basically a function of the haircut, in this case R, which is the haircut you might need on the times by the inverse of 1 minus S, which is quite intuitive, which means that if the National Central Bank either cannot be haircut, or if its haircut doesn't matter because it doesn't reduce the government debt of the country concerned, if S is close to 1, then the only remaining bondholder will have to be haircut totally. Right? It goes to infinity. However, if S is to 0, then the haircut for the bondholder is exactly equal to the average because there's no other senior creditor around. This is just a question of the seniority of de facto of the national central banks. So let me leave it at that and perhaps go back later to the model if there's an interest to that. So let me then therefore go back to the second point about where monetary and fiscal policy meet, and which refers to some work I have done recently with Angela Capolongo, where we just took some of the existing models, especially those used by the ECB itself, and ask ourselves now what would happen in these models if we just have a fiscal deficit of 1% of GDP, because that is the standard shock you can actually perform in these models. And what would be the impact on inflation and on interest rates? So this is what we did in this little piece. Again, you can find the more details on the Vox website. And what we find is basically summarized in these two graphs here, where you see on both sides a dark line, which is the average for the models that we use. And then you see the shaded areas, the maximum and the minimum impact across the, I believe, 9 or 10 models that we have used here. And you see that the impact on inflation is really minuscule. The average is below 10 basis points. The maximum, which is actually, I think, a European Commission model, is 25%. It's, of course, temporary because it's a temporary fiscal shock, but it's really very temporary. The impact on the interest rate is, on average, very similar, but the spread is much, much higher, right? Or the uncertainty across models is much, much higher. There's lots of model uncertainty. Actually, I see that is that the confidence interval or is the spread across the models? No. I'm asking Angela here.
Yeah, no, it's like the spread across the model, like the variation across.
Okay, the so that's I think the legend here is wrong. It's not the 95% confidence interval. I believe it's actually the spread across the models. Yeah. Okay, apologies for this mistake. And actually, you see some negative values there, right? And you would ask, how come, right? And this brings me to my last point, that we found that these negative values you have when you consider the models which were made specially to show how bond buying by the central bank can stimulate the economy by lowering interest rates. And this is, as I said, is my last point, which is this equivalence between the central bank buying bonds and actually the public authority or the state, the government, running a fiscal surplus. So if you run a fiscal surplus, you also reduce the deficit, you also the debt level over time. I've given you here some very preliminary calculations, and of course we can discuss what is the impact of the demand stimulus on GDP as opposed to the lower interest rates you can get in the long term when you have brought the debt level down. But the key point is that, as I said earlier, just for those who believe that the PSPP had a large impact on interest rates and believes actually that the impact has been permanent because the term premium has been permanently reduced. If you accept that, then you must also accept that a sustained fiscal surplus must achieve the same thing over time. So logically, those central bankers who are present in this webinar should also agree that a sustained fiscal surplus should in the end have the same impact as the PSPP. Right? And this is the thought really which I wanted to conclude with. This is not to say that a fiscal surplus is always better, but as I said earlier, we should just be careful in not asking immediately the fiscal authority to say, please run a deficit because we central banks cannot get inflation up. And by the way, anyway, that if you run that deficit, it's almost costless because interest rates are so low. I would say be careful, and in particular, be careful with the idea that the PSPP actually has reduced risk spreads on the periphery, and therefore, mainly, especially for the peripheral countries which pay a risk spread, maybe a fiscal surplus might be a better way to make their bonds safer and scarce, rather than having the national central bank buying the bonds of its own government. So let me stop here. I hope I haven't run too much overtime, and Pierre, you can, I think, take over the Q and answer session.
Thank you.
Question and answer session.
Thanks a lot, Daniel. That was really very interesting and refreshing, and I'm sure that you will have sparked a lot of questions and comments. Let us see if you convince the audience. And I wanted maybe to push you a bit on the policy recommendations you would have based on the results of your analysis. So if it's we should have more fiscal surplus, maybe, then you also made the distinction between low debt holders and high debt holders. What would be your advice?
Okay, let me put it this way. I think here one has to be country specific. I would say for Germany, a low debt ratio, no risk premium, and maybe some need for additional infrastructure. I would see little problem in having some additional infrastructure spending financed by debt. I would have no problem. Whether that is the best policy is something else. Mm-hmm. Would that policy have an important impact on interest rates and inflation? I don't think so. So the position of Mario Draghi saying, you Germans, you want higher interest rates, then go out and run a deficit and you get them. Mm-hmm. I think that piece of policy advice, I think the direction is true, but the magnitude is very low. Let me take Italy, let's say, or Portugal, right? Highly indebted country, potentially high risk premium. There, I would say, get your deficit down if you have any. Of course, not cutting infrastructure spending, but others, that's quite clear. And actually the payoff will be over time much larger than the 2% interest rate or the 1.5% interest rate you see, because over time you will get your risk premium down and you will have actually very high payoff from this surplus. So these, let's say, to make it practical, these are the things which I would emphasize.
Okay, thanks a lot. It's very clear.
And
yeah, please.
Stop the PSPP. And the last would be stop the PSPP.
All right. Okay. Okay. Right. I think it sparked some questions. Hugo Cruz says, very interesting. Do you have estimate for the different impact on GDP growth of the PSPP versus budget surplus?
I don't yet. And I think the central bankers should sit down and think this over. In the last slide, I have given some indication. I was tempted to add the Blanchard estimate that that a 1% reduction in interest rate leads more or less to 1% reduction in demand in the short run, right? And that would allow me to make some comparison. The problem I have is in the following. For the PSPP, my own estimate of its impact is very different from that of the ECB. Right? I've cited here one ECB study which says 95 basis points of the term premium. Okay, which I find widely exaggerated, but also this would be with a half-life of 5 years, whereas the gain from lower interest rates with a lower debt level you would have forever. Mm-hmm. So very difficult to compare. And secondly, as you know, my point would be that if I look at the event studies, I see some impact on the risk premium in the periphery, but basically zero impact on the core country's interest rates. And that would suggest that the impact of the PSPP has been very limited. And again, then I would have to have a trade-off between I run a fiscal deficit today that at the first years will lead to a lower GDP, but I will get it back later through higher demand in a much longer period. So it's very much a short-term versus long-term trade-off.
Right. Okay. Thank you for the distinction. So Marion says, interesting take on running fiscal surplus having the same effect on interest rates as the PSPP. But what about the impact of austerity on growth and thus on interest rates and inflation? Is this something you consider?
Yes, as I said earlier, this is a very important trade-off. If I can go back to my slides, can I do that?
Sure. Yeah, we're about to do that. Just give it a few seconds.
Perfect. Okay. So what you just asked here is exactly what we did in this exercise here. So in this exercise, where you see the results here, we take a fully specified model. We take actually 10 different fully specified models, and these models say that that this is the effect you get. Now, most of these models do not have the liquidity impact of central bank bond buying in them. There are only, if I remember correctly, 2 models which have the PSPP in their structure. Because as you all know, these DSG models, difficult to have bond markets in there, right? And now this is my reply to you. It is these 2 models which incorporate the impact of bond buying, right? On the interest rate that also suggest that a fiscal expansion actually has a negative impact on interest rates because it reduces the bond supply. Fiscal surplus reduces the bond supply for the future also. That goes back into short-term, into interest rate, long-term interest rates already today. and therefore the impact of a fiscal expansion in these models can be negative. And actually they incorporate exactly what I said earlier, but in a fully specified model. Right? So it is possible to build a model where this happens. Of course, there might be other models which are different, but what I find interesting is that exactly the models which the central banks now are doing to show how good, how important central bank bond buying is, exactly the same models also show that maybe fiscal surplus is a way to stimulate the economy.
Okay, Marion follows up and asks, but there is not a trade-off in terms of growth as well. What does your model say on this?
Sorry, yeah.
The very last question. So the Marion who asks the first question is asking, is there not a trade-off in terms of growth as well? And ask what your model says on this.
Not my model.
Yeah.
The models which I used there, right? Which everybody can look at. They are on the models database. These models say there's not a trade-off in terms of growth, because the endogenous reactions of interest rates are such that that you can actually get a boost to growth, right? You actually see that also inflation would go down in these models. That's the right-hand side of the graph. I'm not saying not for every model, but the only two models which we have seen which incorporate the bond supply, they have this implication, which is not a necessary implication, just a potential.
Okay, thanks. I could see that some of you are typing questions. There is one which is quite thick and dense, but we're gonna address it now. So Georgo is saying, regarding the equivalence of QE to primary fiscal surpluses, for cyclical demand stabilization purposes, i.e. to maintain full employment, it is not the real interest rate per se which matters, but rather the difference between the actual and equilibrium interest rates. Call it R minus R star. QE would work by reducing R, while primary surpluses also constitute extra real economic saving, thereby also reducing R star. At the zero lower bound, I guess, they might fail to reduce R further, but R star would drop nevertheless. So primary surpluses are unlikely, Gergo claims, to be stimulative through this interest rate channel of reducing R minus R star. On the contrary, the direct negative effect on aggregate demand is more obvious. Yeah. What do you think?
Yeah, I mean, logically, that is true. If you are at the lower bound, then the mechanism which I mentioned earlier, which is incorporated in these simulation results, would not work. Right? If you're at the lower bound for both policy rates and long-term market rates, I hasten to add, right? That is the implicit assumption here. Then, of course, you have only the direct demand effect and nothing much can do. You are stuck, right? Let me add that these model results, they, as I emphasized earlier, they apply, of course, only away from the lower bound. But if central banks, or not central banks, in this case, governments, actually pursue the wrong policy and have fiscal expansions which have a negative impact on demand, right? Then actually this wrong policy could push you towards a lower bound. Mm-hmm. Right? Because it's very counterintuitive, because governments by having this deficits, right, can push you in the wrong way. So that is what I wanted to mention earlier. Okay,
thanks. So we have still a few more minutes, but there are no questions immediately coming up. May I ask you, did you have a chance to discuss that with central banks, the Commission, in the past months? Did you get interesting feedback from them? And if yes, could you share it?
Let's say it's actually very recent that I've been thinking about this in this way, the equivalence there. I must say, when I talk to central bankers about these results, I don't know what they say. Let me look at our models again.
Okay.
And of course, it's not only fiscal policy which can save us from low inflation. And of course, as somebody in the audience already remarked, right, fiscal deficit in the short term has an immediate impact on demand, whereas the benefit in terms of lower debt levels comes lower. And then if you don't have really forward-looking markets, the benefit in terms of lower interest rates might also come lower. It might also come later.
Okay.
Right? And if I may add something which you one of your questions also mentioned, you have, of course, a difference between a cyclical policy and a permanent policy.
Mm-hmm.
So it's one thing to say, please, government, increase deficit this year, because this year we have a downturn in the business cycle, which will likely to be offset next year, right? So with little impact on the long-term debt level. It's another thing to say, as many people apparently are saying today, just ramp up the deficit, make it 1 or 2 percentage points higher for a very long period of time.
Yeah. Thanks. So Mario is asking, would the impulse response be different for some specific euro area countries, perhaps those with solid fiscal capacity?
Yes, a fair point. That is actually what I had implied earlier, making the difference between Germany and Italy. These models here do not make that difference, but I think it can be made easily if you put into your model the threshold, for example, which I mentioned earlier, that the risk premium starts only above a certain debt level. And if you have to calibrate the term premium. Let me perhaps add, and that in these models, in the DSGE models, it's already difficult to model what's called the term premium, the difference between long and short-term rates as a function of bond supplies. If you were to add, in addition to that, a risk premium of the riskiness of government debt as a function of the net debt of the government, that would represent, of course, another level of difficulty, but that would be very important.
Okay. I can see that Georgios is typing a question. I'm not sure it's going to be available in the very next seconds. Well, it is. Does the analysis consider also possible spillovers between countries? Would the impact be a bit different?
A priori, I would say very little. I mean, I know that you can make it, but let me come back to this difference between term premium on riskless assets and the risk premium. So if you think, let's say, for example, PSPP, if you think that it has reduced the term premium on riskless asset, then there, in the euro area, right, then there might be spillover effects. And let me go back to, sorry, I have to go back a lot, to my equation here with the interest rate on government debt being a function of the riskless rate and the risk premium. So if the riskless rate, if you look at the long-term interest rate, then this riskless component could be a function of the term premium. So it could be a function of the PSPP, right? And since this riskless component is the same, there would be spillovers. So if you, with the PSPP, you get a reduction in the term premium on riskless assets, so that would basically benefit also Italy, because the base on which you calculate then the risk premium, or basically of non-payment, would be lower. Right? So in that sense, there would be a spillover effect. Where I would see little spillover effect is for the risk premium on any one country.
Okay.
Right. So I hope this clarifies what I wanted to say.
Yep. Very good. So I think we will be up for closing remarks. I can see that there is a last question coming up, maybe. Maybe not. So okay, yeah. If you'd like to just in one last statement, would want to just okay, yeah. Thomas Meyer came up. Great points. If neither monetary nor fiscal policy works, what then? I think that's a very good concluding remark.
Thanks, Thomas. I'm not saying that neither policy works. What I'm saying is that the central bank bond buying should be used, say, sparingly, and one should not expect to have a big impact of it, and therefore basically I would stop it right now. More babies, of course, would help by increasing the potential growth rate. I'm not saying also that fiscal policy doesn't work under any circumstances. As I said earlier, if you have a situation where the risk premium doesn't matter because you have a very low debt level, then maybe fiscal policy can still work. Let me emphasize one more. It's very much specific on where you are. I would say for highly indebted countries, and that's for me really very important, that should be really uncontroversial. The true cost of additional public debt is not the interest rate. It's much higher. And therefore, for highly indebted countries, one should be very careful by making any R minus G considerations. Yep.
Very good.
Let me stop here.
Yeah, I think we can stop here. There are no pending questions. I think it was extremely insightful. Thanks for guiding us through this world and through your recent analysis. As I mentioned in the introduction, there will be a seminar next week on anti-money laundering, so something quite different. But I'm looking forward to having you, or at least some of you, back by then. For the rest, I don't know if you wanted to add anything, Daniel. Otherwise, I would close it here and wish everyone a very good and productive afternoon.
And I am hoping that the central bankers on the call will know and get down and prove me wrong.
Okay. Good challenge. Thank you again.
Bye-bye.
Bye. Bye-bye.